Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
All right. Hey, everybody. This is Craig Evans with the Norris Group. We are very excited to have our guest on today. Today, we have Kent Ritter, the CEO and founder of Hudson Investing. Kent is a former management consultant, startup owner, and corporate executive turned full-time real estate investor and operator. Kent has achieved financial freedom, and now he is on a mission to empower others to the same through multifamily investing. Kent is dedicated to teaching others how to make good investing decisions. He is the host of the Ritter on Real Estate podcast and YouTube channel, where he provides impactful interviews and practical tips for investors. His goal is reflected in the show's motto, to help others invest like a pro. Additionally, Kent hosts the monthly Indianapolis Multifamily Investing Meetup, which is an amazing group of active and aspiring multifamily investors. In his free time, Kent loves spending time with his family. They were the catalyst for his journey to financial independence. He is proud to be the dad at every ballet practice and field trip. Kent has a beautiful wife and 3 children, all under 4 years old. Kent, man, it is great to have you on. I really appreciate you joining us today, my friend.
Yeah, absolutely. Thanks for having me on, Craig.
So listen, we do things a little differently, because we've got a lot of listeners that listen through, and one of the things that have changed over the last year and a half or so is really trying to get in to know the person behind the career, behind the success, so to speak. So what I want to do is just start out a little bit, letting our audience know a little more about you, what shaped you and led you to the person that you are, So I know that you run an Indianapolis multifamily investing meetup. Is that where you grew up? Were you in that area? Were you in the Midwest? Tell me about that.
Yeah, I grew up in Indianapolis, born and raised in the Midwest here. And outside of spending, a semester abroad, living in Milan, Italy, and 10 years in Chicago, I've been in Indianapolis my whole life.
Okay. So growing up in Indianapolis, what did you think you were going to do when you grew up?
Yeah, good question. I mean, I always knew I wanted to have my own business. I don't really know why I wanted to. My parents were not entrepreneurs. I didn't really know any entrepreneurs, actually. But I always just had that idea in my head that I thought that would be kind of the coolest thing to go do is own your own business, even as a small kid.
Growing up, who was the biggest influence on you growing up as a kid?
Depends on the age, right? But probably my parents or friends would have been, I'd say mom and dad.
You finished high school, you graduated in finance at University of Indiana. Is that correct?
That's right.
All right. So with that, what was your plan going through college? You grew up as a kid, you want to own your own business. Now you're in college studying finance. What's your plan coming through college?
It's a good question, right? I think like a lot of kids out there, especially in the early years of college, I didn't really know. And so, I knew that, I knew IU is where I went to school. I went to IU because I grew up a huge IU basketball fan. And when you're in Indiana, you're kind of indoctrinated into that, right? And then I knew I wanted to be in business, right? But I didn't really know what that meant yet. So IU has a great business school. And so I said, okay, perfect. I can go to IU, I can get into business school. And fortunately that worked out, through a lot of hard work. So I got into business school. I always had really enjoyed investing. I always had enjoyed the stock market. And I had started at that point, kind of really as I got to college, doing some investing on my own, some stock investing. So kind of managing my own portfolio and trying to just learn about things, right? So I started buying some stocks. So that got me interested in that. So I really went and I did finance and econ, and I did really a focus on investing, right? But what investing really meant at IU at that time, and it was really just that, stocks or bonds. What are you going to invest in, stocks or bonds? That was all there really was. Like, I had one real estate finance class at that time. And I remember, like, the key takeaway was, don't pay full price for one house, buy 10 single family homes. That you put 10% down on each, right? But there was nothing like commercial real estate related or anything in the curriculum. Now, I have to caveat that's changed a lot in the 20 years since I've been out of school. And now IU has a great commercial real estate curriculum. And we actually just hired an analyst out of that program. So it's come a long way. So I give them credit for that. But when I was in school, it's kind of back to this. I don't really know what I want, but I know I want to run my own business someday. And I still don't know. And so I talked to a friend of mine's dad who was successful. And I knew they were successful because I knew they lived in a rich part of Chicago. And that was all I really knew, was that he must be successful. And so I talked to him, and he gave me advice. Well, if you don't really know what you want to do, go into accounting, because it's just, no matter what you do in life or in business, knowing how to do accounting will be valuable. Right. And so I picked up an accounting double major. And that lasted until I did an accounting internship. And I sat in a cube and did journal entries all summer. And I was like, I hate this. Right. So dropped to that, something like 9 credit hours short. And I went into management consulting. Cause like, if you had decent grades at my time, you were either going into management consulting or you were going into investment banking. Those were kind of the two big paths, at least in my school. And so I went into management consulting because, again, I thought that it would teach me a lot about business, how businesses work. I get to see a lot of different businesses, a lot of different industries. And again, it would just be a great learning experience for when I, again, someday go and start my own business. Still don't know what it is yet, but someday when I do that, right? And that was kind of as far as I got in school. So I got out of school and I became a management consultant. And I spent the next 12 years traveling around the country, helping businesses solve problems that they couldn't solve themselves. And I got to go to almost every state and work with hundreds of different businesses. And it was an amazing experience. And through that, I did start to see themes on, what works, what doesn't work, right? And why is this business succeeding and this business failing?
Was that the first business that you founded then? In other words, when you came out of school, did you immediately start your business, or were you working for someone?
No, I went to go work for a management consulting firm right out of school.
Okay.
Yeah, I did that for 3 years.
So what was the first business you started then?
So the first business was a management consulting business, but it was 4 years into my career.
Okay.
It was really based on taking one idea that this big management company had, management consulting firm had, and really kind of niching down into a specific technology that was just about to take off. And we caught the market at the right time. We were kind of, at the beginning of the adoption curve. We rode that wave and grew the business to 95 employees, doing over 30 million in revenue in a 5-year time. And then we decided it was the right time to exit that business because we started getting some great offers. And so then we exited that business in 2015. And that was really what led me into real estate, because I had this capital that I knew was coming, because it takes a long time to sell a business. So I knew this was coming, had this capital, and I was like, okay, well, what do I do with it? Right. I was always into investing. So I, had built up a good brokerage portfolio. I was investing in stocks. But one thing that IU had really taught me was you got to diversify. Right. So I knew I didn't want to put all this other money in stocks as well. I knew that I wanted to make sure that I had some diversification. So I started talking with folks that were older and wiser and richer than me, and said, well, what should I invest in? And that was when real estate really came into the picture, because, I kept asking people, and you ask a few smart guys, and they all said, you got to invest in real estate. There were different reasons. There were tax reasons, there was appreciation, there was cash flow. People were doing it for different reasons, but it all came down to real estate. And so that's really what launched my interest in real estate, was getting prepared to kind of exit that business and setting myself up to diversify and have a good portfolio in the future.
most of our audience is single family investors. That's why I was super excited to get you on, because I've done a lot of multifamily in my career. But I always love to bring other multifamily guys on and talk about the niches and the segments of investing that you guys have found especially through multifamily, right? So really, I want to start diving into multifamily with you in the space that you really fill out. So kind of walk me through, how did you end up from what you're doing in consulting and end up in the multifamily space?
Well, it was kind of a winding road, right? So I got into real estate in that way, but I did a lot of different things. So I started out in single family. I started doing some house flipping and buying rental properties with a couple of buddies from college. And, we did a few flips. We built up a pretty decent sized portfolio. We had about 12 single families or duplexes. And man, that became a headache because we were self-managing, and it had gotten big enough that there were issues all the time. And for anybody that's ever flipped a house out there, I mean, you know what kind of a full-time job that is. When you start doing 3 or 4 at a time, it multiplies and compounds. And so I was like, wow, there's just not enough. Like I'm doing a ton of work, but there's not enough scale here for me to live the kind of lifestyle I want to live, because it honestly wasn't producing that much cash flow. I mean, we're making a couple $100s a month off of each rental, but you're one missed renter away on a single family from paying the mortgage. You're one hot water heater away from knocking out several months of revenue. There just wasn't the scale there, and you start to realize how hard it is to buy a good single family rental, and I think it's become more difficult. And so as I started just to educate myself and started to get some great mentors and started to just think bigger, it really became about scale. And that was something from my management consulting days, right? Like that was one thing. Scale is so important to create safety in a business. And it's true within real estate too. And so I found out that I could go buy, 50 units or 100 units, 100 homes at a time, all under one roof in one transaction. I said, wow, this is great scale, right? And then I learned that I could actually get cheaper management. I could hire better managers, better quality managers, but for a cheaper percentage of my revenue, right? I'm not paying 10% in a single family or 8%, whatever it is these days. I'm paying 3 to 5% of my revenue for really professional management, and everything just gets cheaper. You can buy in bulk materials, insurance per unit. Everything gets cheaper as you go bigger. And so it becomes safer. You can also absorb a lot more vacancy, right? Like a lot of our properties, the break-even occupancy, even when we first acquire the property, not even after we improve it, it'll be somewhere 70 to 80% occupied. And these properties are 90, 95% occupied. So there's a great margin for error there. So just a lot of safety built in. So it's about scale, and safety was what led me to multi.
Well, so when you started out and you're coming through single families and SFRs, what do you think, for the people listening right now that all they've done is SFRs, right? What do you think is the number one or the hardest part of starting in that multifamily space?
Just getting the capital, right? These deals are more expensive, but I will tell you guys this, I will break your belief. Everything else is easier. Everything else is easier. It's easier to get financing on a multifamily than a single family. On a single family home, right? Most of the time they're underwriting you as a person, right? They're underwriting your income from your W-2 and all this, right? If I go get a commercial loan, they're underwriting the property and the income the property makes. And most of my loans are non-recourse, meaning I'm not personally liable on these. They're underwriting the property. And as long as I don't do something terrible, like commit fraud, then, even if things did go terribly, I give the property back, but they're not trying to take my house and my car and everything else. And so there's just safety there as well. I think the hardest thing is just, it's the belief that you can go do it, right? Because it is. And I had some great coaches and mentors help me get there to believe I could go buy a 50 unit or 100 unit, right? And I started with a 29 unit. So, I didn't start there. And now we buy 200 unit. But it's that leap, and then it's having the capital to be able to go do it. And that's really where, when I learned about syndication, which is really pooling people's money together to go buy a bigger, better asset than you can on your own. That was really the game changer. So I said, wow, okay, yeah, we can do this. We can pull it together. It's just a private equity model, right? But you go get friends and family and you get everybody on board and you go buy something bigger and better than you can on your own.
When you're evaluating properties, what are the top three things that you're looking for in a property besides what your cap rate's going to look like? From a CapEx perspective, from initial startup of it, what are you guys looking for when you're going to look for that?
Yeah, I mean, it absolutely starts with the market, right? It is you've got to be in a good market, a growing market. What is a good market, right? A market where there's job growth, there's job creation, and there's job diversity, right? You don't just have one employer that might go out of business and everybody in town's out of a job, right? So you've got diversification, you've got growth, you've got economic development happening, because a rising tide raises all ships, right? But it also goes the other way. So you can have the nicest property in town, but if everybody's out of a job, it doesn't really matter. And so you got to be in a growing market. You got to dig down into a sub-market, right? How are the schools? Are they good schools? What's the crime like? What's the walkability? What's the distance to the grocery store and the major employers? And I got to dig in there. So you got to start market, sub-market. Then and only then do you get down to the property and care what the property's like. But from a property standpoint, I mean, when we do due diligence on a property, right, there's two main areas that we're focusing on right away. One is the lease, what's called a lease file audit. And what that is you're looking at all the leases and you're looking to make sure the leases are what's on the leases, that the leases are compliant. You're evaluating people's incomes, you're evaluating their employers, and you're just understanding the resident base, right? You're understanding, do these people have the ability to afford the rent that they're paying? And do they have the ability to afford future rent increases, right? And a lot of that is judged by rule of thumb is your income should be 3 times your rent. And largely it's believed like that's affordable, right? So is your income 3 times your rent? And outside of doing just the review to make sure everything's accurate, I mean, that's a big check, right? Also, does everybody work at one employer? If that employer goes out of business, are all these people going to be out of a job, right? Understanding that. The other thing we're looking at is the physical due diligence, which is the building itself, right? And so we walk every single unit. If we just we are buying a 209 unit property right now in Fort Wayne, Indiana. It was 100 degrees a couple of weeks ago when we walked every single unit, but we still did it because if you're not walking every unit, you don't know what you're taking over, right? And so I would say no matter what you're buying, make sure you see every angle of it, inside, outside. Like I've heard single family horror stories where I knew somebody that bought a house sight unseen, got to the house, the entire back of the house was burnt down, like gone. Like, I mean, that's the worst I've ever heard, but like, we walk every single unit. We walk up 209 units. We look in every nook and cranny. We get contractors that we trust on the roof, scope the sewers, check the termites. I mean, just everything.
Yep.
And so, I mean, those are some of the things that you just start at as you start to look at these.
Where did you buy early on in your career? Did you buy local or were you looking outside of your local market at different markets that maybe had better industry, things like that going on?
Yeah, I did a little bit of both kind of at the same time. And so, I believe that when you're starting, if you're going to be the one really managing and really overseeing that property, even if you're not the day-to-day manager, you really do have to think about logistics and how long it takes to get to that property. Because if you think you're going to go buy a property that's, 3-hour flight away and be able to really successfully oversee that, which people do, I just don't really believe that you can oversee that in the way that really needs to be overseen to be successful. So I think you got to really, I would say I undervalued that at the beginning, really valued that now. And is it drivable? Or do I have a team member that is going to be getting out there and knows that's part of their job description and they're comfortable with that now as we've evolved, right? But when I started, it was just me. I wanted it to be drivable because part of my mission of going into real estate and getting out of management consulting was to be home for my family. Because in management consulting, I traveled all the time and I didn't want to be doing that all the time. So if I bought a property 4 hours, across the country, I'd be traveling and I wouldn't be really living, the reason I got out of management consulting.
Yep.
And so part of it was that. But I will tell you, I did buy one of my first purchases was a big property, 250 units down in Atlanta. But it was through a group where I was a partner. I was one of the partners. We had partners with boots on the ground in Atlanta. They were running kind of the day-to-day, week-to-week, right? And so because of that comfort level, I was willing to do that. So you can do both. I just think somebody's got to have their boots on the ground and be familiar with that market. It can be a partner, but it's got to be somebody.
How many of your properties, I know you said when you were starting in the SFRs, you were in the single family space, you were self-managing. When you first started in the multifamily, did you try to self-manage any of that at all? Or did you hire management companies from day one?
No, we hired management companies.
What kind of cap rate are you looking for when you're looking at deals from a multifamily perspective?
Well, it depends on location and asset class, a lot of different things, right? But mainly location and asset class, meaning that different parts of the country demand different cap rates. If you are in a primary market, right, high growth market, a big city, it's going to demand a lower cap rate than if you're in a very rural area, where there's just not a lot of competition. There's not a lot of properties trading. I mean, that's just going to be at a higher cap rate. Relative risk is going to be higher. And then if you're buying, an A property, a brand new property, right, in a prime location, that's going to have a lower cap rate. If it's a lower cap rate, it means a higher multiple, right, on your income, than a property that is, in a bad neighborhood, and falling down, right? So there's kind of everything in between, but I would give you kind of generally, one really important thing to take into account on what your cap rate should be is going to be your interest rate on your debt. And so, one thing I don't think you want to be is inverted, meaning your cap rate is lower than the interest rate on your debt. Because your cap rate can also be looked at as what is the cash flow that's coming out of that property day one, right? So it's a 5% cash flow. If you didn't have any debt in place, you'd expect a 5% return on your money. And so if you look at that interest rate and say, okay, my interest rate's 5.5%, my cap rate's 5%, then, you're just going to be in a tougher position. You're going to be in a cash crunched position from the start. Versus if your interest rate is 5.5% and your cap rate's 6.5%, you're going to have some cash left over,
right?
At the end of the day. And so that's just a way to make sure you're being safe, kind of as you make your investments. And that's one of our first kind of criteria is, can our interest rate on our loan, is there a spread between that and the cap rate? And is our interest rate below the cap rate we're going in? So that's one of those rules of thumb that we look for.
How many employees do you have now, Kent?
About 30.
Okay. So you've got teams that are helping evaluate properties and they're looking at things. It's that all, I would assume that's not all falling to your shoulders now, but
no.
When you first started, because again, we got a lot of people that have been talking to us about multifamily. And again, I got a long background in multifamily. I mean, one point we had a little over 1,000 doors and primarily all multifamily. And so, I like bringing other people into the mix that multifamily is what they do, right? So, and that way it's not always just coming from me, right? I want people to hear that there's a lot of different philosophies and thoughts on how to work that. But when you were first starting through that process, how much time were you putting to finding the deals and evaluating versus going through? In other words, what did you find out of it? And I understand it's market specific. When there's not as much competition, it can be harder to find the deal. But for people that are trying to get into multifamily, what would you tell them? Say, hey, listen, guys, you're going to see, you're going to have to look through 30 before you find one potentially, those types of things. What did you see out of that?
Yeah, man. Good question. And
I know that's a baited question because it depends.
yeah, no, it's good. So, I think a few years ago, I think pre-interest rate run up in 22, I think you had to look at, our rule of thumb is always 100 deals to win one. And,
Yep.
and it would basically work like this. It would be, you had 100 deals. You need to be able to discount, basically swipe. I don't use the dating app, so I don't know which way, but you're swiping left, I think, on 70% of those deals. So 70 out of 100, before you even underwrite them, you just need to be able to say no, because they are not meeting some criteria. It's not the right market. It's not the right age of asset. It's not in the right area with the right incomes, the jobs I talked about, right? All that, because you can't underwrite every deal, because especially when you're starting, it's going to take you 3-4 hours to do a full underwriting. And so you just can't keep up with that volume. So you got to have a really good criteria to discount and get rid of a lot of deals before you even get to underwriting. So you get rid of 70, right? You get 30 left. Okay, these 30 we're going to dig into and we're going to underwrite, right? And then maybe of those 30, 10 of them, we're actually going to put offers on, because once we underwrite them, put all the numbers in and see how everything shakes out for a 5-year business plan. Okay, we like it. All right, we're going to put offers in on 10 of those, and we hope to win one of those, right? And so it just shows you, like, I think when I started, I didn't understand what a volume game this is. It is a volume game. You have to be able to churn through a lot of deals. You have to be really efficient at it, because that's the only way. And what I find, and I fell into this, right? As a rookie getting started, you get your hands on one deal, and man, you want to look at that thing every which way from Sunday, and you fall in love with it, and you get emotionally attached to it, and you do all this and that. But at the end of the day, it's not really a good deal. And the reason you're spending a lot of time is because you're trying to, well, what if I do this? And what if I do that? And, if you're doing that, it's not a good deal. It's not. You just let it go. And the only way, I got great advice from a mentor who said, how you get over that deal? Go look at 15 more. And you just keep doing that, And so that's really what it was about for me. It was just understanding that mindset of, you got to get really efficient at saying no quickly to deals, because most deals you should be saying no to. And you got to have capacity when those ones come.
Well, and the thing with that is, if you can't, you're never going to scale.
That's right.
Right? I mean, you'll get stuck in those two, trying to figure out how to make those things work, versus, like you said, all right, I've already looked at 20 while you were looking at 2.
Well, and I want to go back to, I said that was like pre-22 run up, right? Since interest rates have run up, there's less deals and less good deals, because there's less deals that work. I mean, it's a lot easier to make a deal work at a 3% interest rate than a 6% interest rate.
That's right.
And so I think you got to look at, I don't know what the number is, but it's 150 or probably 200 to get one. It's gone up. It's gone up, and we actually keep all those stats. I just don't have them on top of my head, but we look at hundreds, if not thousands, of deals a year.
Hey, that's going to do it for us this week. Make sure and join in next week for part 2 with Kent Ritter.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.